Hey guys, welcome to Investify, where we help you grow your wealth through smart investment. Today we will discuss the top 5 stocks the smart money is buying for the 2023 recession. Exciting stuff, right? These stocks are not your ordinary shopping list. They're more like those wild, out-of-the-box ideas that pop into your head at 3 a.m. Yeah, we all have those moments. Consider this an ideas list, a playground for us valued investors to explore in our own time. Get ready to be amazed as we unveil the stocks that have caught the super investors' attention in the thrilling first quarter of 2023. No foreign names, just good old English language stocks to make your heart skip a beat. Let's start. Here are the top 5 stocks the smart money is buying for the 2023 recession. Number 5. Intuit. Starting with the 5th most bought stock in quarter 1 by the super investors, Intuit. 7 of them hopped on the bandwagon. Intuit is known for providing financial management software to small and medium-sized businesses, but you might recognize their brands like TurboTax, Credit Karma, QuickBooks, and MailChimp. However, there is some puzzlement surrounding the hype. Intuit faces potential headwinds in the coming years, such as rising interest rates that could impact their Credit Karma business and potential unemployment increases affecting TurboTax. Even the IRS has reported a decline in filed tax returns year over year. With the stock trading around $415 per share and a PE ratio of about 60, it doesn't strike me a screaming bargain. While the super investors found it appealing, I remain unconvinced. If any of you have more insights to shed light on this, please share in the comments below. Let's crack the Intuit case together. Number 4. Meta. Moving on to the 4th most bought stock in quarter 1 by the super investors, Meta. Formerly known as Facebook, Meta has been at the center of controversy in the recent years. They have faced challenges due to their substantial spending on metaverse development, the impact of reduced advertising targeting on Apple devices, and the difficulty of monetizing short-form videos. These factors caused the stock to plummet, experiencing a significant 70% drop from its 2021 high to its 2022 low. However, things have taken a positive turn in 2023. Since hitting its low point in November 2022, Meta shares have surged impressively, gaining approximately 180%. It seems the super investors had excellent timing on this one. There have been some encouraging signs from Meta lately. In their most recent quarterly earnings report, the company posted its first year-over-year sales increase in 4 quarters, with revenue growing by 3%. However, it's worth noting that costs also rose substantially, leading to a 15% decline in operating income and a decrease in operating margin. Nevertheless, Meta has issued optimistic guidance anticipating second quarter revenue between $29.5 billion and $32 billion. Even at the lower end of that range, it would still represent a 2% growth compared to the previous year. As the famous investor Peter Lynch once said, sometimes it's not about catching a stock going from good to great, but rather identifying turnarounds from being in a rough spot to a slightly better position. In these cases, institutional investors often step in and help turn things around. All in all, it's an intriguing time for Meta. Despite the challenges they face, the super investors have shown remarkable confidence in the long-term potential of this business. That's why Meta frequently appears among the most bought stocks in their portfolios. So that's the story of Meta. Its up and downs, the recent positive developments, and the fate placed in it by the super investors. Number 3. Microsoft. Turning our attention to the 3rd most bought stock in quarter 1, Microsoft. 9 of the super investors jumped on board. Microsoft has been riding the wave of AI. And since the release of ChatGPT in November 2022, their stock has risen by about 40%. Although Microsoft doesn't own OpenAI, the creators of ChatGPT, they are a significant shareholder and have a close partnership. They initially signed a $1 billion deal with OpenAI in 2019 and later invested an additional $10 billion this year. This led to the speculation that Microsoft has a strong influence over OpenAI. The market has been pricing the future of AI into Microsoft stock, and even Bill Gates has increased his holdings, making it the largest position in his foundation's portfolio. While the success of ChatGPT hasn't had a significant impact on Microsoft's financial results yet, the company's core software businesses remain their driving force. From Windows to Office 365, Azure, Xbox, LinkedIn, and more, Microsoft has a suite of powerful software that keeps customers locked in and generates consistent revenue. Ultimately, it's the strength of Microsoft's core business that likely attracted the super investors. While AI is exciting, it's the enduring software foundation that made Microsoft an appealing investment. Number 2. Amazon. Now let's shift our focus on the second most bought stock in Q1, Amazon. 13 of the super investors recognized the potential and eagerly joined in. If we take a glance at their stock chart, it becomes evident why. Over the past 6 months, the stock has essentially reset to 2020 levels due to the challenges posed by the macroeconomic environment. Amazon has been actively expanding its capacity to boost revenue and profitability. However, the current inflationary pressures have led to a corresponding increase in costs. Rising costs of goods sold and operating expenses have impacted Amazon's earnings. Nevertheless, many valued investors view this as a short-term hurdle that will pave the way for long-term success. Amazon is renowned for its exceptional capital allocation, constantly reinvesting funds into strategic growth areas within the business. While other companies hoard their cash, Amazon and Tencent stand out as they continue to proactively invest in their expansion. This approach highlights their firm belief in the promising opportunities they have identified. Number 1. Google. Finally, we come to the most purchased stock in Q1, Google. This tech giant consistently ranks high on the list of super investors' favorites, and it's not hard to see why. Google's ability to maintain steady revenue, its strong moat in internet search, and its solid financial position with significant cash reserves make it a compelling choice. Despite the challenges faced by advertisers in recent times, Google's profitability and resilience have remained impressive, making it an attractive long-term investment. In Q1, its stock price hovered around $90 per share, adding to its appeal for investors seeking value. That wraps up our discussion on the top 5 stocks that smart money is buying for the 2023 recession. Now, we would love to hear your thoughts on these stocks. Which one do you find the most promising? Feel free to share your opinions in the comments below. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.